So imagine scaling a business so rapidly that your revenue doesn't just double. It doesn't even triple. It multiplies by 20. Yeah, a 20x revenue growth. In a span of just 10 short years, this explosive growth is exactly what PG Electroplast has achieved. It's an absolutely monumental feat in the manufacturing world. Today we're going to unpack exactly how they pulled off this incredible scale-up and, maybe more importantly, what happens when that unstoppable momentum hits a sudden economic roadblock.
Welcome to this explainer. Today our focus is squarely on decoding PG Electroplast. We're going to analyze the staggering historical growth of this Indian electronic manufacturing services giant, and then we're going to contrast that long-term boom with the very real, kind of complex micro-realities found in their Q4 FY 2026 financial report. So if you're fascinated by supply chains, corporate finance, or honestly just love a good deep dive into business strategy, you're in exactly the right place.
All right, let's dive right into this. Here's our roadmap for today. We'll start with a decade of massive growth, then take a look inside PG Electroplast, cover their core business verticals, hit the Q4 financial realities, and finish up with how they're navigating economic headwinds.
Starting with our first section, a decade of massive growth. We're talking about a 35.1% compound annual growth rate over the last 10 years.
Now, to truly grasp what that 20x statistic actually means in the real world, we need to look at the numbers that build it. Back in the 2015-2016 financial year, PG Electroplast reported revenues of 263 crores. Right? Fast forward a decade to the 2025-2026 financial year, and that top-line revenue has leaped to an astounding 5,343 crores. I mean, just think about the sheer logistical achievement there. That isn't just your standard, steady, incremental growth. That is a complete, fundamental transformation of scale that literally reshapes an entire industry.
But how did they actually do it? Well, this growth was absolutely not accidental. While the top-line revenue grew at a 35.1% compound annual growth rate, their EBITDA, which is basically their core operational profitability, grew right alongside it at 35.4%. And this was driven by massive, deliberate capital expenditure. Over the past 10 years, they've poured over 1,900 crores into building out their capabilities. They focused heavily on an organic growth strategy combined with exhaustive backward integration, basically meaning they didn't just expand their assembly lines. They bought up and built out the supply chain behind their products to capture a lot more value from every single unit produced.
Moving into Section 2, inside PG Electroplast. Let's look at their scale and infrastructure. So what does a 1,900 crore investment actually look like on the ground? Well, PG Electroplast has built a massive physical footprint. They currently employ over 10,000 people. I mean, let that sink in for a second. Over 10,000 employees coordinating every single day. They operate out of 11 different manufacturing units spread strategically across India, in Greater Noida, Ahmednagar, Bhiwadi, and Roorkee. This geographical spread is a tremendous strategic advantage for them. It lets them minimize shipping bottlenecks and stay incredibly responsive to the localized regional demands of their massive client base. And this brilliantly illustrates the specialized factory floors dedicated to highly complex capabilities like plastic injection molding. They aren't just slapping logos on generic products here, guys. They are providing comprehensive one-stop ODM, that's original design manufacturing, and OEM, original equipment manufacturing solutions. This means they're designing products from the ground up and manufacturing them to exact client specifications. In fact, these sprawling assembly lines serve over 70 leading global and Indian brands, churning out millions of precision units year-round. No small feat. Next up, Section 3, Core Business Verticals. Basically, how they make their money.
Their absolute biggest engine of revenue is their products vertical, which focuses entirely on consumer durables. When you think of PG Electroplast, you should immediately think of temperature control and home appliances. We're talking indoor, outdoor, and window AC units manufactured on a massive scale. And alongside those ACs, they're pumping out top-load washing machines and a wide variety of air coolers. Everything from window and desert units right down to personal coolers. It's high-volume, high-demand consumer tech through and through.
But you know what? They're much more than just an AC manufacturer. They've effectively diversified their revenue streams across multiple heavy industries. While products handles those consumer durables, their plastic molding vertical serves completely different sectors, molding critical parts for sanitary ware and automotive components. Then you've got the electronics vertical, which turns out televisions and highly complex printed circuit board assemblies. And finally, their tool manufacturing division creates the specialized molds that make all of this possible in the first place. It is a highly integrated, highly diversified industrial web that insulates them from relying on just one specific sector.
Let's move to and see how this builds into Section 4, Q4, financial realities, and the recent headwinds.
So after a decade of basically riding a rocket ship, the latest quarter revealed some, well, serious turbulence. If we look specifically at the fourth quarter of FY 2026, operating revenues dropped to 1,716.7 crores. Compared to the 1,909.9 crores generated in the exact same quarter of the previous year, that represents a 10.1% year-over-year drop. Now, in the context of their historical 35% growth rates, a 10% contraction, that's a significant pivot that absolutely demands a closer look.
But here is the central tension of the entire Q4 report, and honestly, the most fascinating part of this whole analysis. While top-line revenue only dipped by about 10%, profitability took a much, much more severe hit. EBITDA plummeted by 43.2%. Profit before tax fell by 54.5%, and profit after tax, the ultimate bottom line, was down a staggering 56.1%, right? So why on earth did profits essentially cut in half when sales only dropped by a tenth? That brings us to Section 5, navigating economic headwinds and understanding that margin squeeze. The first two culprits driving this squeeze are global inflation and higher commodity prices. Think about it. When the raw materials required to build ACs and washing machines, things like copper, specialized plastics, and steel, when they suddenly spike in cost, and you can't immediately pass 100% of that cost onto the consumer, your margins get squeezed right from the very top. The company report actually notes that their gross contribution fell by 23.8% in the quarter. Simply put, it just became significantly more expensive to manufacture their core products.
So the crucial point is understanding this exact phenomenon, negative operating leverage. This is a core finance concept that every focused learner really should have in their toolkit. When a company has massive fixed costs, like paying for land, heavy machinery, and constant factory upkeep, those bills are due whether you sell one single unit or 1 million units, right? Therefore, when sales decline even just a little bit, profitability drops by a much larger proportion because those immovable fixed costs are suddenly eating up a significantly larger percentage of your shrinking revenue pie. Think back to the beginning of our deep dive today. Remember those 11 sprawling manufacturing units and the 10,000 employees? Well, that is the physical embodiment of massive fixed costs. That incredible infrastructure, built by over 1,900 crores of capital expenditure, requires consistent, high-volume production to remain highly profitable. When the volume drops, like it did in Q4, that very same infrastructure transforms, at least temporarily, from a massive competitive advantage into a pretty heavy short-term hurdle. Which brings us to our final thought. We've seen the explosive 20x growth, and we've analyzed the severe margin squeeze of Q4. So the question we're left to ponder is this: can the foundational strength of a 1,900-plus crore investment shield this EMS giant from the harsh realities of modern economic volatility? Is a single difficult quarter just a blip on the radar of a manufacturing powerhouse, or does it signal the limits of hypergrowth in the face of inflation? It's a genuinely fascinating case study in industrial scale. Keep learning, keep analyzing, and we'll see you next time on The Explainer.